Hi, everyone. This is Rob Roy. We just finished the live U.S. market update over on the Hub Financial channel. If you'd like to watch it live, go over and register at the Hub Financial channel. You're currently watching the recording here on the EWO channel. We talked about the markets on this consolidation that's going on. At some point, we're going to get a breakout. We reviewed the CPI and PPI reports. They didn't seem to do much. We talked about Jamie Dimon's comments on the banking sector, as well as his views on Congress playing around with the debt ceiling. And don't forget, if you have a specific stock of interest, you can go right to it clicking the chapters feature here on the recording. Enjoy the video. Have a great weekend, everybody. Hi, everyone. Welcome to this week's U.S. market update. Taking a look at the chart of the S&P. Gosh, not much has happened since last week. The pattern has been the market moves to the downside in the first half of the day and then rallies back in the second half of the day. And then in the end, nothing. So here we are with this small symmetrical triangle. We've been looking at triangles. It's like triangle mania right now in the markets, which means to me that something is getting ready to happen. So we could go all the way back over here and draw this as a big, large descending or a symmetrical triangle. But I think that because of the recent pattern, we just stay with what's going on since November. And you have a large ascending triangle with a symmetrical triangle right at the point here. Now, the one positive thing here is the market does not want to give up that 410 level. Let's take a look at that real quick. So there's the triangle. You can see where we close today, just above 410. And you look at it and how important this 410 level has been, which is kind of why I redrew the line for an ascending triangle. You can see that we got up here and tested it. It was resistance back in November, December, got above it, but couldn't hold it and fell back here in February. Again, tried to get above it in March, fell back, tried again here into April, and then now here we are into May, and 410 still matters. So I think that's the level that you want to watch as far as the markets. How we handle the 410 level, I think, is going to determine which direction that we break out. We did close just below the 10-day moving average, but above the 50-day moving average. And again, just right at that 410 level. So I think there's not a whole lot else to say other than I really do think that we should focus on the fact that something significant is getting ready to happen. When we take a look at interest rates, we look at the fact that we've held here in this 410 area, in the 34 area. And I don't know why that's such a big deal with the 10-year, but it's clear that the 34 level matters. And we have a descending triangle here on the 10-year. So equities, bonds, all are in triangle patterns. Again, telling you something of significance is getting ready to happen. I like the interest rate area staying here or slightly above. As you know, if you've been watching these recordings, anywhere between 34 and 40, I think is a sweet spot for the markets. And then if we take a look at the dollar, last week we talked about Jeffrey Gundlach had come out, and he's one of the few guys that I pay attention to because he's a big bond guy, and bonds are important. There's more money in the bond market than the equities market. A lot of smart people in the bond market. He felt like the dollar was going to go down. So far, that hasn't played out. We've been holding this area here right in this 101 area. So what's going to make the markets move? We talked about this in TradeFinder on Tuesday night on whether or not perhaps the upcoming inflationary reports would make the markets move. So guys, if you have that slide on TradeFinder, I'd like to invite everyone to join TradeFinder. We do it every Tuesday night, 9 p.m. Eastern time. We look at the markets, we look for trade ideas, and we have a live Q&A. It's a lot of fun. We have a great community there. They ask great questions. So love for you to be a part of it. So you can sign up on the link or just go to our website, ewotrader.com, and you can sign up there. So TradeFinder is a great thing. Love to have you. All right, let's take a look at some of the other markets, and then we'll talk about the non-effect that those inflationary reports had. So here's the Dow, looking at the DIA, 340 is important here. Now, unlike the SPY, which is holding above its big number, which is the 410 level we just talked about. The DIA is hanging below its support resistance level. You can see the importance of 340 there. Another thing to note, once again, no 5-wave, LA wave qualified pattern in either the SPY or the DIA. And we're kind of down at the lower end here on the DIA. So a bit of a tight range other than this March area here where we broke below it. But other than that, going all the way back to November, we've been ping-ponging here between 330 and 340. Which way are we going to break? Same thing, not necessarily the same kind of triangle pattern. I think you can make an argument that from those March lows, there's a little bit of an ascending triangle here. It's not as clear cut as the SPY, more of a trading range here, but yet a breakout above 340 is obviously bullish, below 330 is bearish. So looking at the Qs, it's the one market that's been in a 5-wave qualified pattern. And we put the LA wave pattern on. You can see that nice march to the upside there. And we have put a little bit of distance, not a lot, but a little bit of distance above its primary level, which is 320. So holding above there, looking at the moving averages, even though closed a little bit lower on the day-to-day, still above the 10-day moving average and still above 320. So the Qs remain the most constructive of the markets as far as the upside. And then the IWM getting into the whole risk on, risk off type of a scenario is holding in this 170 level. We've talked in the past about how the trading range has been 170 to 190, but going back to March, April, so the last couple of months here, the range has tightened up between 170 and 180. So you could argue that the IWM is kind of along the lines of the DIA in a trading range. So we've got the big triangle in the SPY, trading ranges in the DIA and the IWM, and the NASDAQ, the one that's trending up. We've talked about this before, that if the next move, and I heard some commentary on the financial networks today saying they're not so sure the Fed's done. But the Fed Fund Futures is saying that the Fed's done and that the next move is going to be a rate cut. And the forecast based on the Fed Fund Futures is a rate cut in September. So what numbers do we have to see? You know, the earnings reports haven't been that bad. Certainly a lot better than expected. So what would it take to prompt the Fed to cut rates? The Fed Fund Futures, when it gets to a 75% forecast, has a pretty good accuracy level, but we're going to have to see some really ugly data coming in before that occurs. And so when we take a look at the VIX, you can see that looking here, the VIX is below this area of 18, going up and testing 18 on the high. So we've just basically broken below support and then consolidated. So what was supported 18, and we've been hitting the highs here along the 18 level. But I thought, you know, as I mentioned on Tuesday night, that the inflationary reports might be what moved the market. We had the CPI report that came out on Wednesday, and the CPI showed that it was in line or slightly better, depending on whether you looked at the regular headline number or the core number. So that didn't seem to move anything on Wednesday. Then we go to Thursday, and we have the PPI report that comes out on Thursday, and same thing, almost identical. So CPI is consumer prices. That's what we pay. PPI is producer prices, meaning that's the wholesale level. Supposedly the Fed prefers looking at the PPI, but we know their favorite inflationary indicator is really the PCE. So I saw some commentary how the Fed's looking at this, you know, the PPI report with more scrutiny than the CPI, but I don't buy that. I think they like their PCE numbers. So both those numbers came in line or slightly better. Nothing happened to the market. So here we are, still trading underneath this 18 level. And I don't know, Dux, what it's going to take to move the markets, but something has to spur the markets from here to generate some sort of a breakout of these trading ranges or triangles, depending on which pattern you prefer. Yeah. So here's the KRE. As you mentioned, this is the ETF for regional banks. And you look at the pattern, and that's pretty ugly. Can you say catch a falling knife? When is that going to stop falling? We had negative news this week, but that I thought maybe with renewed concern about it. I'm surprised at this. I've mentioned the fact that the Fed opened that lending facility window for banks. And how are their banks? It was PacWest was the one that came out this week. How are they still having problems when they have this facility from the Fed to go borrow money? I thought that might be a bigger concern. You can see it's on the ETF. It hasn't been for the general market, though, not so much. So we have this vertical move to the downside here. Maybe it is the debt ceiling, as you mentioned, Ducks. Jamie Dimon came out, and he's one of many that have been warning Congress to not fool around with this debt ceiling. Janet Yellen says we have enough money till June 1st, but Jamie Dimon from JP Morgan Chase was saying they have a war room. So basically, they've been meeting once a week on contingency plans if the government was to delay raising the debt ceiling. So maybe that creates some sort of a breakout. And then he says, as we get closer to the end of the month, towards that June 1st date, they'll start meeting every day to figure out a game plan on what could happen. I don't know what you think, Ducks, but to me, this is all political theater. I hate this whole game plan. Everyone in Congress knows the world's watching. They get their 5 minutes of fame. They make their little speeches. They get their own agendas mixed into it. But they don't want to fool around with this. I agree with that. I just don't think they will. I think they'll push it to the 11th hour like they normally do. And then at some point in time, they'll get it passed. Does that spur things to the upside? Maybe. Do we get so concerned about it as we get close that we break to the downside first? It's going to be an interesting couple weeks, Ducks. And I've mentioned this. So if you've watched these recordings, if you haven't, you can go back and watch. We had this vertical move, and then we went into a triangle, and I was pretty impressed with the way Bitcoin consolidated that vertical move. I don't like vertical moves because quite often they get retraced. We broke out of that triangle with another vertical move. This time, it did get fully retraced, and we came right back down, and now we've been going kind of sideways to slightly down underneath the point of that breakout. And you can see that we're hanging on. My analogy of holding on by your fingernails with falling off a cliff, one of my favorite analogies I talk about a lot, right there, 27,000. We're just a hair under it at the time of this recording or the time of this live session here. And I just feel like if we can't hold 27,000, then I think we are going to come down and give back some of this vertical move. The first place of support that I would look for if we break below 27,000 is there at 25,000. That was the wave 3 high. That would give back the last part of the vertical move just before this little consolidation in mid-March. So yeah, nail biting time for Bitcoin. You're right, Ducks. And you can see that we've been struggling with the 64 level on Coke. We are in a qualified 5-wave pattern to the upside. It's one of those defensive sectors that when we do go into a recession, which I think is still highly likely based on how long we had an inverted yield curve. If we can break above 64, I think I would just keep all hands on deck right now on Coke. But if we break above 64, then I think we're high likelihood that we run up and hit that wave 5 target there around 67. So I was pretty impressed by the fact that there was a lot of people out there in the Twitterverse talking about Coke today. Elon announces the new CEO for Twitter. He talks about price increases on most of the cars in Tesla. And the key here is that we are in still a 5-wave pattern of the upside, but there's caution here. Danger, Will Robinson, I still think here on Tesla. We did hold 160, which we said we needed to hold. We talked about this, Ducks, in past live market updates, that if we couldn't hold 180, we were going to 160. And that's exactly what happened. And then this gap that filled, and we've talked about this, we talked about it on TradeFinder 2 weeks ago, is the fact that if we can hold 160, perhaps we come up and fill this gap. Well, look, we've done that now. And so I think that the 160 to 180 range, again, kind of keep your hands on the, quiet as far as activity in the Tesla. You break below 160, it's a good short. There's nothing there. That's fairly vertical. If we can't hold 160, I think Tesla is coming down to 120, perhaps all the way down to this wave 5 low from January, back down at 100. I know that's not going to make all the people that love Tesla, which there's a lot of them, very happy, but that's what the charts show. However, if we can break above 180, because we still have a qualified 5-wave pattern to the upside, then perhaps we can take off on another leg higher on Tesla. So, you know, he had cut prices. Now he's raising prices, so he's kind of flip-flopped a little bit here. He cut prices when the big guys, GM, Ford, and all cut prices because he felt like he needed to compete, and then he's changed his mind. He's raised the prices back up again. So is that enough to propel it above 180? That would be impressive, and that's when you can go long Tesla, in my opinion. But be real careful here, because a break below 160 and it gets rough. You know, we've talked about this a couple weeks, Ducks, here on the 260 to 280 range, and we had this big run to the upside here in this massive wave 3 in Nvidia. And then we've just bounced back and forth between 260 and 280. Then we broke above it. And one of my rules is that if you break out of a major point of support resistance, moving average, triangle, whatever, you have to have a follow through day. So we broke above it here back on the 1st of May, no follow through, moved back down below 280. Then we tried it again, a little bit of follow through there. So you have to wonder, are we testing 280 now? Because we did break out with a follow through day. So this to me looks like perhaps we're testing that 280 level. You can see the earnings report is not too far away there on the 24th coming up. So sitting right above 280. With that, if at the beginning of the week, if we hold 280 and try to break up, you could make a speculative long. But let's also make sure that we're all aware of the fact that Nvidia is priced for perfection. It's got a high multiple. It has to come in with good numbers. A lot of people think that it's going to, but if it disappoints, then we could be looking at a break below that 260 level. But right now, if we bounce early next week or throughout the week next week into earnings, then an earnings report that is a solid earnings report could really propel the next leg higher in Nvidia. But it needs to do something, because it's been in this range since mid-March. You can see this sideways consolidation following that big move. The negative here is this gap. Get concerned about gaps. We have some AI components at evotrader.com that we use in our alert service, etc. It's really cool, and the AI tells us that 94% of gaps get filled. It's not 100%, so not all of them do. The problem is you don't know exactly when it's going to get filled. Sometimes they get filled immediately. Clearly this didn't, but at some point in time it could. Yeah, they're going to fight that, and I think they probably have a pretty good chance of prevailing there. So where the gap is a little bit of a concern, the fact that we've gone sideways here and done a pretty good job of consolidating the big gap up. If they can get some positive news coming out of that case, then perhaps that propels Microsoft higher. So it looks pretty solid here with the consolidation. Just keep that gap in the back of your mind. If it starts to break down, if it broke below 300, I think that would be your stop if you're long Microsoft. The management at Amazon seem to think that, there's the little dust ups here and there on unionizing, and they don't seem too concerned about it, but that's what they're saying. How do they really feel about it? What's being discussed behind closed doors, we're not privy to that. Just what they tell the media is that it's not that big of a deal. But you can see that we came back down, but we had two vertical moves to the upside there, 2 big days where we sprinted higher. So a little bit of a pullback is warranted there. You can see we got overbought. That's another one of my rules. No security in any time frame, gets very far away from the 10-day moving average. A lot of our subscribers at evotrader.com have talked about how they've incorporated that into their trading and what a big difference it's made. When you get the separation there, it isn't going to last. So coming back down a little bit, but we're sitting here at 110, and I think if Amazon can hold 110, that's really bullish. And even if it needs to come back down and fill that gap, and holds 105, I still think you have to be constructively bullish on Amazon. The only time I would start to change my opinion on the whole cautiously optimistic thing would be if Amazon broke below 105. Then the narrative changes completely. But anything above 105, I think is okay. If it can hold here on this test of 110, let the 10-day moving average catch up. I think that's gold. And if it just fills this gap and reverses, I think that's okay too. So 105 is my level on Amazon that I think needs to be watched closely.
If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.